And welcome back to Sigma Trading. Today I'm going to expand on the subject of trading without charts. And the idea is to provide some additional elements that are needed not only to understand how to trade without charts, but also to emphasize the need for some elements that must be present for the strategy to work correctly. Now, some people do not really believe it is possible to trade without charts. They are so used to the idea of the need of having a chart, of a graphic or indicators or whatever in front of their eyes at all times in order to understand when to buy and when to sell. But what I intend to do is to prove this is not true. A person can very easily trade without any charts, and a lot of great investors are doing that. So there are really alternatives to spending hours and hours and hours looking at charts and graphics. And I will explain you what is needed to do this in an effective way. Now, trading without charts for many people feels like flying blind. And there is an element of truth in that, in the sense that price action becomes a kind of invisible when no charts are used. But that doesn't mean it doesn't work. It works perfectly well, just taking into account certain elements that really need to be present. So I'm going to explain you what these elements are. Now, the first element is, of course, money management. Management is extremely important because this approach, the Sigma trading approach to investing and trading, is based on strong skills in money management. What does it mean? It means that the idea is to keep buying and selling certain companies again and again and again. But that means that the amount of money that can be traded each and every time for each and every transaction must be in line with the total amount of money a person has. So to give you an example, suppose you're trading only one company, which is a very bad idea, right? But suppose you are trading company whatever, and you have 1,000 euros on your account. How big can a trade be in order to compensate for the price changes that company whatever goes through? Now, we said initially that the standard delta, standard difference in price that justifies a buy or a sell of company whatever is, for instance, 10%. So you buy at 10 per share, that share price goes down by 10%, that justifies another buy transaction. And if it goes down 10% from there, that's another buy transaction, and so on. So, which means that the share price of company whatever can go down from any different, from any price situation down to 100% in the mean, which means company whatever basically goes bust, right? Well, this is not a base case we're going to make, because I'm going to assume, and I'm going to check the company whatever is actually a solid company. So what is realistic for me, for instance, to imagine the share price could go down at maximum? Let's say I imagine that the so-called drawdown, the difference in share price from peak to the lowest point, is 50%, right? So I have 1,000 euros. I imagine company whatever could go down 50% from the first time I buy it, which means I need to split this 1,000 euros into 5 parts, which means every single time, every single transaction cannot be bigger than 200 euros, right? I buy 200 euros the first time, it goes down 10%. I buy it again at 200 for 200 euros, goes down another 10%. I buy it again, other 200 euros of the same company, and so on. So one of the things that is really important in this approach is to keep the amount of money involved in each and every transaction as small as possible. So it is going slow and it is going small. Slow because, well, because most of the times share price do not change that much. In fact, in my observation, most of the time share price remains relatively static for an extended period of times across the companies I'm currently trading. So there are a few among many that I have that register on a daily basis some serious movement, say about more than 2-3%, but 10% is quite a lot. So the fact that the strategy is actually slow in execution depends on the fact that the share price changes are relatively rare, so it doesn't happen very often. And the small side has to do with the fact that each and every transaction must be as small as possible in order to preserve sufficient money, cash, in order to continue the buy activity. Okay, so always have cash on the side, because if the share price goes down, it is needed to buy additional shares in order for the strategy to work as it should work. Which also means in practice that it's almost impossible, or should be impossible, to be all in at any single point in time. So having 1,000 euros doesn't mean that a person is assuming to get 1,000 euros to work all in the same time. So the basic assumption is at a certain moment, after having bought company whatever 2 or 3 times, at a certain moment company whatever will be sold. One of the transactions, the last transactions, will be sold with a profit, which means the amount of cash will fluctuate. Sometimes there will be more company whatever than cash, and when the share price goes down, the cash decreases and the amount of share increases. When the share price of company whatever goes up, then transactions will be sold, cash will be returned with profit, and the amount of share will decrease. That's a bit the amount of there's a bit of the dynamic that is around this whole concept. But what happens if one of the biggest risks, one of the biggest problems of this strategy is that one cannot or should not invest all his money at the same time. So there must be always cash available, right? So also there, the amount of cash available, the size of the account, really determines the amount of companies that one could imagine to trade. With 1,000 euros, I wouldn't personally trade more than one company, imagining, of course, a minimum transaction of 200 euros each time. If one has 10,000 euros to trade in this way, then the amount of companies can go up considerably. All right. On this one, and just anticipating, there is a lot of discussion about the need for cost control, which is extremely important. So just touching on the subject. Depending on the broker a person uses, every time a buy or sell transaction is executed, there are trading costs. All right, so buying 10 shares costing each 10 euros will cost you 10 by 10, 100 euros. But your broker, depending on what broker you are using, will probably calculate trading costs, which means every time you buy, they will have a fee to be paid, or which can be or a fixed amount, or for instance, a percentage of the trade size. For the moment, my situation at the moment is that I pay a fixed amount of money every trade I make. Okay, that's what my broker asks to be paid. Those costs, let's imagine that I pay €5 each time I buy and €5 each time I sell, right? So every time I perform a transaction and I want to calculate my profit, I have to take into account the cost involved in buying and selling. So let's go back to company whatever. I buy €200 of company whatever. Share price is 10 a piece, so I buy 20 shares. The amount of money that cost me buying company whatever is €200, but I pay €5 to buy and €5 to sell, which means in total, the total amount of money, the total amount of costs that the full cycle transaction buy and sell cost me is €10, right? Which means my investment, my total investment is not €200, but 200 plus 10, because those €10 as cost must be calculated. In the moment I want to sell this company for a 10% profit, this transaction for 10% profit, I must make sure that those €10 are calculated as well. All right? Which means that I need to have a system that allows me to calculate and to make visible what are the costs involved into these trading activities. And that comes to the very important subject of having a tracker in place. Now, a tracker is called a portfolio management system. Sometimes it's called like this. It's basically a way to track what each transaction actually costs. The reason for the need to have such a tracker is that many brokers are not particularly good in calculating profit transaction by transaction, which is the core element of this trading strategy. What they normally do is to calculate profits on a position level. So company whatever, the first time you buy company whatever, the first transaction is also a position. The second time I would buy a company whatever, the position would remain only one. But there are two transactions, right? So for what concerns many brokers, the position as such could still be in negative waters, could be losing money, on paper of course, but one of the transactions I executed on company whatever could be profitable. Okay, so that's why the tracker, this portfolio management system, is essential, because without that, it would be very, very difficult, if not impossible, to understand if within a position one or more transactions are potentially profitable and could be sold. Now, how does the tracker looks like? Okay, so the tracker must register each and every transaction. Each and every transaction that I register has, of course, the company name, it has the date, it has the amount of shares purchased, it has the cost per share, and it has the total cost of the shares I bought. Separately, there is an element related to costs. Now, as I said, my broker presently calculates a fixed cost per operation, per transaction, but in some cases there are additional costs related to some of the transactions I make. Those must be included into the total cost of each transaction. Once I have the total cost of each transaction, I can request my spreadsheet, because this is a spreadsheet what I'm talking about, to calculate the 10% profit on top of what the total I paid for that particular transaction. That total, the total cost of the transaction plus the, for instance, 10%, will give me the amount of money I want to get out of that transaction in the moment I sell it. And it is extremely important for me when I create a sell order. If I don't know for how much do I need to sell that transaction, I risk to lose money, because obviously if I buy something for 10 and I don't know what is the 10% of that 10, I can't really give a rational sell order to my broker, right? So the sell order for that transaction is based on the calculation of the total cost of the buy transaction. On the same line, there must be a space where I register also the elements of the sell transaction. So when I insert a buy transaction, I put all the elements in, I get a minimum sell price for that transaction, and on that basis I give a sell order to my broker. When that sell order is executed, I go to the broker ledger and use the elements of the sale transaction, and I include them in the tracker as well. So each transaction eventually will have a buy element of it with the date and a sell element of it. Now the sell element is made of the sell date, of course. It will be including the amount of money that sell transaction created, right? And with those two elements, I know, first of all, how much each transaction actually generated in terms of cash, how long that trade has been going on, and also when multiple transactions are opened and closed, I will have a very clear indication of the total amount of money that the trading activity has generated. One of the things that it's quite normal, and it happens a lot, is that traders are under the impression, looking at the account value, that their trading activity is going well or going bad. Now, if the account value goes up, one would assume that a trader is making money. But in fact, in a number of cases, even when the account value goes down, the trader is actually making money. And that has to do with the difference between paper losses and cash losses. All right. So, as I told you before in another video, I consider a paper loss, unrealized loss, as a no loss. All right. It's simply the fact that the shares of company whatever have been going down 10%, but as long as I don't sell them and I don't take that loss, and it doesn't transform itself in a cash loss, that loss doesn't exist. It's just a question of time before company whatever will go back to the price it was having before and possibly go higher. Okay? It's what is called a drawdown, so a decrease in share price. For me, that is completely non-existing. I don't consider it. So what happens is that by using the tracker that I created, I could verify the fact that the strategy is actually making money, and it is based on the fact that I can see how much cash is generated by buying and selling company whatever. And that is, I mean, that becomes obvious and very clear once I look at the amount of transactions I make, how many times I bought and sold company whatever, how much money I generated, cash money I generated each and every time. Now, this is something that many brokers do not really do very well, okay? Because for a broker, there is no real difference between a paper loss and a realized loss. They are looking at the total value of the portfolio at that particular moment. They might or might not consider, they normally do, the amount of money that was generated in the past. But yet, if the amount of money generated in the past is above the amount of unrealized losses present today, that might or might not be visible when you look at the account value that you're using for trading company, whatever, and many others. By having your own tracking system, it is possible to conclude if a certain strategy works or not. Now, I know the Sigma strategy works because I know how much money it generates, and I know that the amount of money that is lost in unrealized profits is just nothing. It's a temporary situation. It's a drawdown. Is the fact that a certain company is not particularly popular at a certain moment in time, so it loses money on paper, but in fact is still exactly the same good company that it was originally when I bought it the first time. So it is irrelevant. The other very important element that must be present in the tracker is to keep track of the dividends. Now, dividends are another one of those that are, in terms of reporting, very, very different from broker to broker. So what happens is that, as we remember, the idea is to buy a company and to sell it as quickly as possible for a certain profit. If that doesn't happen, I expect that company to generate dividends in the meanwhile. So between the time I buy it and I sell it, this company must be able to generate dividends. Those dividends represent a very important part of the total profit of the strategy, right? At the moment, for me, they stay around 30 to 40% of the total value of my profits. The rest 60%, 70% are trades, but 30, 40% are dividends. Now, the tracker must register those dividends as well. All right. So when I started to use the tracker also to have a visibility on how much money was coming out of dividends, I realized two things. First of all, that only trading or only dividends are working, but are working a lot slower than otherwise. But the combination of the two is really interesting. And it uses at the maximum the power of waiting, of time. But anyway, the bottom line is that the tracker is fundamental. If I wouldn't use a tracker at the moment, I would have basically no clue on how the strategy is actually working. And the only element I could see is the total account value. And since the total account value is influenced by the unrealized losses that in sometimes are normal, today is October the 16th, there is a lot of stuff going on, stock markets are depressed, and my total account value is in the red. Should I be worried? No, because I know that most of the companies, if not all of the companies I have at the moment, are fine companies. And they made me actually a lot of money up to now. Almost all of them, 90% plus of all the companies I ever bought, I realized some kind of profit. What some of these companies are still in such a situation is that they are losing money on paper. And that, again, is not a worry for me at all. The Sigma trading strategy is also based on the maximum level of diversification possible. And why is that? Well, it is due to the fact that let's take company whatever, right? Company whatever, I buy it on the 1st of January. The idea is to sell it when the share price goes up 10%, or to buy it again when the share price goes down 10%, for instance, right? Now, this 10% could come within 1 day, 10 days, or 100 days. I don't know. So in order for me to generate as much cash as possible, I need to have as many companies as possible that are constantly fluctuating in share price. For me, volatility means money. And the amount of companies that I would like to have is as many as possible, because I can count on the volatility on many companies in order to perform transactions, buying and selling. The net result of the story is that having sufficient money, a person can start to trade a large number of companies. Again, remember, these companies are characterized by being good, solid companies and paying good amount of dividends, right? And this is something that a person must select themselves. I mean, there are funds, index funds and ETFs that are based on dividend, but they are paying really poorly. So in my opinion, and what I did is always been a stock picker, so I select these companies myself. But anyway, the more companies there are, the more price fluctuations there are, the more opportunities there are to buy and sell, right? So the diversification that is, I think, fundamental for the strategy to work properly is meant to offer as many buying and selling opportunities as possible. So now let's look at the practical application of what I just told you, right? So let's go back to our sequence of transactions and let's imagine how would that work. So the first buy of company whatever is A, right? First transaction, I have, say, 1,000 euros. I imagine that company whatever could go down maximum 50%. I divided my 1,000 euros by 5 and I come to 200, right? So I actually invest 200 euros in buying a certain amount of shares of company whatever. Then I wait for a while and I see what happens. But I insert this transaction in my tracker. So I know exactly what I bought those shares for and when. Now the tracker must also be able to register almost real time the price differences of the shares of company whatever. So it must be updating the quotes for the company whatever. So I must know how much money are the shares of company whatever each and every day. I don't want to do it manually, so the tracker must do it automatically. There are ways to do that. I'm not going to spend time describing that, but anyway, the quotes for share price must be updated automatically. Anyway, I bought 200 euros worth of company whatever. Now I wait, and we're going to B. When we're going to B, what is B? B is a moment where my tracker tells me that the share price of company whatever has gone down 10% from the last time I bought it. So B is 10% less than A, which means at that point the tracker tells me, okay, according to the plan, the trading plan that I set up, 10% difference, now is the time to buy it again. It's the tracker that tells me that, right? So I buy it again, and now I have 400 euros invested and 600 euros in cash. We're going to C. C is exactly the same as B. C is the result of the tracker telling me that the share price has gone down 10% versus B. which means it is the time to buy it again. Which means now I have 600 euros invested and 400 euros in cash. D, again, now I have 800 euros invested and 200 euros in cash. And so on. When it comes to E, it's still the tracker that tells me that D has gone up 10% in price and it is now sellable for a 10% profit. If I didn't have the tracker in this particular situation, what I would see is company whatever is down 40%. Something less actually, because it's 10%. Well, it's a long discussion, but let's not be super precise here. Let's say it's around 40% down, right? But without a tracker, I wouldn't know that transaction D can now be sold for a profit. So that's the real important of that element. And that's really the important aspect of keeping track on each and every transaction. This is a transactional system, remember. So we're now in E, right? I sold D, I made 10% profit on that transaction. I recovered 200 euros. The 200 euros I invested in D, so my cash position is now increasing. And the share price, the amount of shares is decreasing, which is perfectly normal. When the share price keeps rising, the tracker informs me that at F I can sell C. Again, is the tracker, right? What I do. And I keep doing this, time and time again. Always the same company or the same companies, the companies I like, which I keep trading, time and time again. Now, during this period of time in which I trade company whatever, can be years, really. If the company remains good, what I will do is keep buying and selling this company. But it is not in the graph, but don't forget, sometimes this company will also issue dividends. So, and dividends will be issued maybe once per year, twice per year, 4 times per year. And those gains are adding up to each and every transaction that I close with a profit, right? So the longer I keep trading this company, assuming this company remains good, the better it is, because the price action, the volatility that everybody is scared about, is actually one of my best friends. When the share price changes, I have opportunity to buy and sell. And while this company remains good, I will continue to cash in dividends time and time again from this company. So in theory, once I created my list of good companies that I want to trade, as long as those companies don't change from a fundamental viewpoint, I will keep trading them. And the funny thing is that, as I told you in a previous video, I don't really need to look at graphs to do this, because I buy them. I register a transaction in my tracker. I wait. I check my tracker once a day, and I see if it is the time to buy or sell this company again. That's everything I do. And since the sell orders are good till cancelled orders, I insert them once and basically I forget about those. There are nuances to that, but it's not the time now. But imagine company whatever is a euro denominated company. I trade in euros. So a 10% profit on 100 euro or 200 euros is 20 euros. Okay, so that is not going to change. Since I trade also companies that are denominated in other currencies, like Swedish krona, Finnish, Danish, Swedish, Polish, and whatever else, for those transactions is a bit different because there is a currency exchange. There's a currency exchange changes, forex changes that need to be taken into account. But it's a bit too early for that. At the beginning, it's perfectly fine to identify a few companies denominated in euros that would allow me to establish buy point and sell point euros for euros without having to worry about currency fluctuations, right? Currency fluctuations, trading on the euro companies are irrelevant. What can happen is that by function of time, so waiting long enough, the amount of money that is accumulated in this way exceeds the amount of companies that I would like to have that are interesting for me to buy. Okay, so it happened in the past and it will happen again in the future that I have a relatively small list of companies where the share price is for me interesting to buy or sell, but I have a lot of cash available, sitting on a lot of cash, because I don't have good trading opportunities at that very moment. And that is the go small and go slow. No activities must take place outside of the trading plan. So for me, it's essential that, this can happen, and it happens actually a lot of times. During certain days, nothing happens. You know, it's share price do not really change. The companies I have in my portfolio are basically stable. There is no opportunity to sell. There is no opportunity to buy. There are no other companies I'm interested in at that very moment. So the amount of transactions for that day is nil. Nothing happens. And this can go on for many days, even weeks in certain moments. And it is perfectly fine. I mean, there is a certain amount of cash that remains unutilized, but that amount of cash also represents my edge, because without cash, this whole strategy becomes a no-edge strategy. Cash is the opportunity to buy and sell companies, particularly buying them when the share price goes down, as long as the company remains interesting to buy. One of the things that is very important to consider as a risk to the strategy is the use of margin. Okay, this strategy requires that a person use no margin or as little margin as possible. Margin is debt, basically taking loan from your broker and investing or trading with money that's not yours. Because in this strategy it is perfectly possible that a company share price goes down by 50%, it doesn't represent a problem if the money invested in this company is yours. But in the moment the money invested in this company is not yours, is actually a loan, you might find problems with your broker because of margin requirements. The share price goes down too much and your margin becomes too large, then the broker might force you to sell a part of this company at a loss because you don't match their margin requirements anymore. So one of the rules of the game here is actually to avoid as much as possible the use of margin, which means that yes, it is a strategy that requires a relatively large amount of money, but it is a strategy that allows also for flexibility, in the sense that if one doesn't have much money, the amount of companies that can be included into this trading strategy can be as small as one. The only difference between having one company whatever, and having 10 or 100 companies traded at every single point in time is just the speed of change, the speed of profits. Okay? So imagine, for instance, that using a 10% approach, a company share price could go up and down any given share price, point A. Suppose it goes down 10% once a year, and from that moment it goes up 1%, goes up 10% again once a year. So it goes from, say, you buy at C, you go down at D, and it goes back to E, right? This is a one purchase, two purchase, and one sell. This could be happening just 3 times a year, which means that investing only in one company will provide only one time a 10% cash profit. However, during that year, and let's imagine this lasts a year, that company, because it is selected as a cash paying company, a dividend paying company, during that year, that 10% profit on one transaction must be added to the amount of dividends this company will pay. So it's not 10%, it's more, could be 15%. So one having more money than, say, 1,000 euros, let's say you have 10,000 euros, you can play this game for 10 companies. 10 companies that are trading each and every of them 3 times a year, which means 30 times, plus dividend. You do the math. It's a lot of money, a lot of cash money generated by trading these 10 companies and no more. Just having the patience to wait for price changes and the pleasure of seeing regularly dividends coming in by doing basically nothing. 1 hour a day is everything that takes me in trading the companies I have, and there are not 10, there are many, many more. And the only thing I need to do is to see what are the price changes that are taking place from my tracker that require a buy or sell activity. That's everything I do.